Thank you for having me here. So the rest of the afternoon, I'm going to talk to you about trying to understand why one of the most used models works. Okay? And it's going to be highly tied to the way information comes into the market. And when we see how information comes in the market affects the model's fit, it's going to call into question a bit how we want to think about these factors that we're exposing ourselves to. Right? Are they truly risk, or are maybe they something else in addition to risk? Okay? So let's start by thinking about how risk and returns happen at the casino. Okay, so suppose we want to spend an hour at the casino betting on the roulette wheel. We're betting single numbers. Okay, your expected return is something around the order of negative 60%. Okay, so does that mean we just lose steadily 1% of our money every minute while we're at the roulette wheel? No, right? This comes in very lumpy turns. Right, the roulette wheel's not spinning all the time. Now, how about in an individual bet, right? We put our money down, we bet on 0, okay? So they spin the wheel. Do they start taking slowly the negative 5% return we're expecting to get on that bet? No, right? Nothing happens until the ball falls in the cup. In this case, right, we'd win our big payoff, but if it had fallen 26, right, we'd have gotten nothing, okay? The key idea is returns occur when risk is resolved. Now, this idea in and of itself isn't new, but what we're going to do is take this to financial markets and the study of the factor structure of asset returns. Okay? So keeping with this analogy, right, financial markets operate very similar to the casinos, right, except we have positive expected returns, right, much better deal. Okay? So we know already that returns accrue unevenly throughout the year. Right? A few examples are earnings announcements. Okay? We see big price moves in returns when firms announce their earnings, and this is going to be the information event we're going to spend time thinking about in this paper today. We also see this with dividend announcements, macro announcements, right? When the Fed releases what it's going to do with the federal funds rate, we see big market moves, okay? And firm-specific events, mergers, announcements, right? CEO changes, so on and so forth. Okay? Our traditional models really treat returns as earned uniformly through time, or at least uniformly in expectation, right? We saw in the last discussion, right, the formula that was put up, right? How did we earn our returns? It was some risk exposure times the amount of time we're exposed to it. Okay, what we're going to do is sort of break that analogy, right, and show how that lumpy information releases is going to cause, right, our returns to occur lumpily. Okay? And this is going to give us really interesting return patterns, and it's going to affect how we properly measure risk, and it's going to generate an interesting factor structure in returns. Okay. So what we do in this model is we're going to build kind of the simplest model we can to illustrate this phenomenon. So we're going to think about two types of firms, firms that announce their information early and firms that announce their information late. Okay, so to put this in perspective where we're going with the data, right, we're going to think about firms that announce their earnings at the beginning of the quarter and firms that announce their earnings at the end of the quarter. Right? In our model, we're going to assume these firms have no difference in risk. Okay? And by no difference in risk, I mean they're going to have the same terminal cash flow distributions. All right? In the model, because they have the same endogenous cash flow distributions, agents are going to demand the same expected returns. Okay? So you can get very interesting factor structures even with no risk differences. Right? In our model, the CAPM fails. Okay? We have a world where the CAPM fails, but you supplement the CAPM with a factor based on the spread in the early versus late returns, okay? And this will price assets. Okay? And what's going to be a key prediction of our model is that our alpha reduction from this supplemented model is going to occur primarily in the early announcement periods. After we go through the model, we'll go and look at the data and see if we see evidence of this. Okay? So the first thing we're going to see is there's systematic differences in when firms announce. We find small firms announce near the end of the quarter, big firms announce near the beginning of the quarter. Value firms announce near the beginning of the quarter, growth firms announce near the end of the quarter. Okay, so these early versus late differences line up with the characteristics we're used to thinking about firms having differential returns on. Okay, we're going to look at the Fama-French three-factor model and see how it performs across the year. And we're going to find the improvement of the Fama-French model is concentrated in the early announcement periods, at the beginning of each quarter when firms primarily announce their earnings announcements. Okay? We'll look at the data and see if a traditional risk-based story drives this, and it's going to turn out early versus late announcers really have basically the same average return, right? So this argues that it's not a traditional risk-based story that's driving this result. And finally, we'll show how announcement timings affect SMB and HML exposures, right? So in addition to the characteristics of size or book-to-market ratios, right, varying when a firm announces, okay, will also systematically change its SMB and HML exposure, right? So let's get into the model. So this model is based on some earlier work with a different set of co-authors, okay, where we look at returns across different frequencies. All right. So in this model, we have investors with just terminal exponential utility over wealth, okay, and there's going to be 3 dates, okay, 0, 1, and 2, and investors are going to consume their terminal wealth at date 2. We're going to have risky assets, okay, and they're going to pay a cash flow at the terminal period that's described by this stochastic process. Okay, we can think about our F as being our systematic, right, economy-wide event that occurs that all firms are exposed to. Okay, that's stochastic. And we're also going to have a stochastic asset-specific exposure to this shock. Okay, so this is going to be kind of the key place where we're adding a little twist to standard models. And the intuition is as follows. Okay, everybody knows the distribution of the B's and the F's. Okay, you can think about a B as a firm's average exposure to systematic news, right? For lack of a better word, right, it's cash flow beta. Okay, but the key is, right, all systematic events are not homogeneous. Okay, systematic events are different, and for each event, right, a firm is going to have a specific exposure. Okay, so let's think about learning Congress is going to take up tax reform. Okay, so this is a systematic event. Okay, we know the size of the systematic event based on, well, how big of the scope of the package is Congress talking about? Okay, are they talking about tweaks around the edges, or is this going to be a complete overhaul of the tax code? Okay, so we're going to have big versus small systematic events. Okay, but then given this tax reform, we have to further figure out for each individual firm, okay, is this firm going to be highly exposed to this tax reform, or is it not going to be highly exposed to the tax reform? Okay, now let's take a different piece of systematic news. That say Congress is going to take up immigration reform. Again, we examine the size, right? How big of a package are they talking about? Tweaks around the edges or a major overhaul? Okay, and we're going to have the same firms, right, might have different exposures to tax reform than they have to immigration reform, right? Even though these are both major systematic events. Okay, does that make sense to everybody? Now, what we're going to think about, we're going to add one further twist, and this further twist is going to be that we're going to have M of our firms are going to be early announcers, okay, and the rest are going to be late announcing firms, okay? And what I mean by late announcing firms is going to be when do we learn about the firm-specific exposure, okay? So we can think about, right, at each date we're going to learn our systematic shock, our F, right? Congress is taking up its systematic, right, its tax reform, okay? But for some firms, we learn the specific exposure early, right? The firms that announce their earnings early, right? And we see everything management has to say and how this news about tax reform has affected their earnings over the quarter. We're learning that early, okay? For the other firms, right, we're not going to learn this right away. We've got to wait until they announce their earnings to figure out their full exposure to this, right? So our late announcers, right, the proxy for the firms that announce their earnings at the end of the quarter, right, the Bs are going to be delayed one period. Now, a key part of this is that agents are going to infer something about the late announcer's exposure from the early announcer's announcement, right? We're not going to know the B for the late announcers, but we are going to know the F. Okay, so as the F varies, right, we're going to change, right, how important it is to know about this B. Okay? Okay, right, this captures the idea that, right, early in the quarter, right, we learn a lot from firms who announce early, and then later on, right, we're not learning the systematic component anymore, but we're learning the individual firm's exposures. Okay, and this sort of inference problem is going to give us very interesting return patterns. Right? Now again, it's key. These early and late announcers are going to have the same risk. Okay, they're going to have identical cash flow distributions up there, right? They're going to face the same stochastic process, right? The only difference is going to be when we learn the different shocks. Okay, same unconditional distributions, right? Just when do we learn them? Okay, and in the model, right, this gives endogenously identical expected returns. Okay, what we're just going to have is a slightly different information timing. So let's see the main main solution. Okay, so we're just going to give you a parameterized value. Standard risk aversion, again, our 3 periods. We're going to set slightly more than half of the firms are going to be early announcers. This is consistent with what we see in the data. Most firms announce early in the quarter, but there's still a substantial fraction that announce late. And we're going to pick a very simple stochastic process for the F's and the B's, right? Just F is big or small, right? 1 or 0, and the B is 1 or 0. Equal probabilities, everything's independent. The key result here, okay, is that when we look at how the CAPM prices these assets in this model, it fails, okay? And it fails in a very particular way. We have alphas across both periods, but we have much larger alphas in the first period, okay, when the main information event comes out, okay? If we supplement our market model, right, the CAPM, with an early minus late factor, right, to capture how these early announcers behave differently than these late announcers, okay, what we get is this does price assets, okay? And by looking at the bottom row, we see the vast majority of the alpha improvement comes in the early announcement period. Now, what's the intuition for this? All right, so the intuition for the model is follows, okay? This information structure kind of messes with our ability to measure betas properly, okay? So late announcers are going to have this time-varying conditional risk, okay? And this time-varying conditional risk comes from the fact that, okay, if we learn the systematic news today is big, okay, this means it's really important the piece of information we don't know, okay? If this tax reform is going to be huge, it's really important the piece of information we're lacking, and this conditionally makes the late announcers riskier. On the other hand, right, if we learn Congress is having it just tinkering around the edges on this tax reform, right, it really doesn't matter that we don't know how these late announcers are completely exposed to this, right? Their conditional riskiness goes down, okay? What we're going to get is this discount rate effect is going to move in the opposite direction of the cash flow rate effect, okay? When the systematic shock is big, okay, the firms become riskier, they have slightly different movement, okay? But this discount rate effect is undone over time. Eventually, we learn this information, and we earn the average expected return for this conditional riskiness. Okay? And this is why the firms have the same unconditional expected returns, whether they announce early or they announce late. So what this does, this difference covariance, it dampens down the covariance of the late announcer firms with the market. And because this is an equilibrium model, right, it biases up the betas of the early announcers. Okay, so what we can think about is the CAPM betas that we measure are really our true beta that we'd like to measure plus some error. Now let's think about the market returns in this model. Okay, because there's more information released in the first period, right, we're getting the systematic shock plus all of the firm-specific exposures of the early announcers. Okay, so there's more information released. Because more information is released, more risk is resolved, so we get higher expected market returns in the first period. Okay. Now, our expected returns on our assets are going to be approximately our true beta times the expected return on the market. Okay. But our alphas in the CAPM, right, they're going to be the difference between these expected returns, and right, we're messing up our beta measurement. Okay. So we're going to have some error at the end of the day, right, this error in our beta measurement, and it's going to be proportional to kind of the size of the return in the market. Okay, and because the market return is bigger in the first period because we have larger amounts of information released, right, our alphas are going to be higher in the first period. And when we stick in a factor, right, based on this early versus late spread, it's going to clean up this error in our beta measurement, okay? It's going to get rid of our alphas, and because it's cleaning up these alphas, right, our alpha improvement is going to be in the early period, right, though there will be some in the later periods. So that's the model. Now let's go to the data and see if we see any evidence of this phenomenon going on. Right, so the first thing we need to know, well, are there systematic differences in how firms release information in the market? And the information we're going to think about is earnings announcements. So let's look at the fraction of earnings announcements over the whole sample versus months of the year. What we see is a very strong pattern. Majority of firms announce in the beginning of each quarter, okay? And it trails off through the entire quarter. The only real difference here is January and February, where you can kind of think about January and February combined being the early announcement period and March being late. Okay, right? The annual reports take a little bit longer to process. Okay, and the announcements happen kind of on the border of January and February as opposed to occurring squarely in 1 month. Okay, and we're actually going to see, right, this evidence of this anomaly showing up in asset returns. All right. So now let's look at announcement patterns by the Fama-French characteristics. Okay, so what we're going to do is each quarter, we're going to assign a label to a firm of when do you announce. Do you announce in the first month of the quarter, the second month of the quarter, the third month of the quarter? Okay. And then for each of the 25 size and book-to-market sorted portfolios, we're going to assign you one of these labels. Okay? We're going to just aggregate across quarters, right? We're going to treat quarter 1, quarter 2, quarter 3, quarter 4 the same. Though in the paper we break it out. It sort of really doesn't matter, this aggregation, but we'll just look at one table here. And we're going to look at what fraction of firms announce at each quarter by each characteristic. So what we see here is going from small firms to big firms. Okay, the percentage of firms that announce in each month of the quarter. Okay, so each colored line is a different book-to-market ratio quintile. Okay, what we see is this strong pattern of fewer small firms announce in the first month of the quarter than big firms. Okay, and then subsequently we see this pattern reverses in the later months of the quarter because the small firms that didn't announce have to announce in the later months. Okay, so we see big firms consistently announce earlier than small firms. Okay, and this is on the order of magnitude of about, a 20% difference in the first quarter. Okay. We see a similar but smaller pattern in book-to-market ratios. Okay, it's a little harder to see because the difference is around 4% to 5% difference across the firms. We can see it more as we get to the later quarters, later month of the quarter, right, because we see more firms, right, who've kind of averaged out. The same effect is there, it's just not quite as strong. Okay, so we see big firms consistently announce before small firms, and we see value firms announce slightly earlier than growth firms. Okay? The effect is much stronger in the size quintile, but it's there in the book-to-market sorts as well. So we see differential earnings announcement, right? Different information released into the market. So we've got step 1 of what we needed for the model. Now let's look at our alpha prediction. Okay, so our alpha prediction was, right, the concentration, the reduction in alpha should occur early in the quarter. Okay. When we usually run time series regressions to test asset pricing models, we just think of 1 alpha. Okay? So what we're going to do is build on this, but we're going to look at an alpha for each particular month. Okay? So it's basically putting in, right, 12 intercepts as opposed to 1. Okay? Because we want to test this prediction of, well, when does the improvement to the Fama-French model occur? Right? Our key test statistic is going to be the average absolute alpha, right? We just want a very simple way of adding up how much this improvement in alpha occurs. Okay? And what we're going to look at is the reduction in absolute alpha from the Fama-French model to the CAPM. Okay? So here we see the alphas, okay, the average absolute alphas for the CAPM, the Fama-French model, and the change. Okay, and this is for the 30 Fama-French industry portfolios. We see basically all the improvement is in the early announcement months. Right? Here it's primarily in January, July, and October. Okay? And we see a little bit in February. Right? And the way to think about this is January and February are really kind of the early announcement period, with March being late because there's a slight delay. Okay? In fact, 82% of the improvement occurs in the key earnings announcement months. And if we include February, it goes to 100%. So 100% of the alpha improvement occurs in these early announcement periods. Okay? Now our expectation, right? My expectation going into the project is just, it's going to improve the fit evenly across the months. Right? So we'd expect, well, about 1/3 of our fit would be in each quarter. Right? That was my prior going into this. And so we want to test, well, is this just a fluke? So we bootstrap, right? We randomly draw months of the same length, okay? Recreate time series where we just randomly draw different months. And we find that the aggregate difference, right, this 82% or 100%, this is significant at the 1% level. So this is not just a fluke, right? It's not easy to get this concentration. we see a similar effect in the Fama-French 25 portfolios. Here we get 71%, so it's a little bit lower, but these portfolios were also sorted to be particularly exposed to these factors, so it's not surprising that the effect is a little bit lower, but still we see this amazing concentration of when the improvement of the model works. Okay? We also break this down by looking at kind of a Fama-French two-factor model, and we see SMB mainly improves January and October, okay, and HML mainly is what drives the improvement in April and July. Okay, so there seems to be even a slightly more interesting factor structure beyond just looking at the whole model. So we see it's not driven by just adding conditioning variables, right? Just allowing the betas to vary. This does not solve it, right? This is very consistent with prior results in the literature that, right, a simple conditional CAP-M does not seem to drive why the CAP-M doesn't fit. Okay? It's also not driven by there's something weird going on in these announcing months, right? It's not just because we've had a few crashes in October or other things. So, right, it really does seem to be something particular about this, the way we're fitting this model, right? Something about these alphas really are different. Okay? So now let's drill down to the expected returns, right? We saw our alphas, so let's look at the expected returns that are underlying this model. Okay, so first, let's look at the factor returns across months of the quarter. Okay, so what we're doing here is we're averaging across all the first months of the quarter, right? January, April, July, and October, all the second months of the quarter, all the third months of the quarter. If we look at the market return, well, what do we see? We see it's highest in the first month of the quarter, just like we'd predict in our model, right? This is when most of the information seems to be hitting the market, right? We're getting this information from all the firms' earnings announcements. It's concentrated at the beginning of the quarter. Yes, we do earn returns the rest of the quarter as we get information throughout the year, but there is this concentration at the beginning of the quarter like we saw in our model. Okay? SMB. We get this interesting result that most of SMB's return comes in the third month of the quarter, right? This is when small firms are announcing and big firms aren't. Okay, so we also see HML. We see a big chunk of HML is earned in the first month of the quarter when the value firms are announcing. Okay, so we're seeing these factor premia are also earned when the relative long versus short parts of the portfolios are announcing. All right? So we see just overall aggregate returns on these factors seem to be moving consistently as predicted with the model. Right? Now, one might worry that maybe this is just kind of a simple risk story, right? Maybe there's some difference in riskiness about early versus late announcing firms. Okay? So what we do is we just classify firms by whether they announce in the first month of the quarter or announce in the last month of the quarter and compute their average returns. Okay? We do it equal weighted or value weighted, and we really see no difference between early versus late announcers. Okay? So this argues that these firms have the same average returns, so our traditional view of asset pricing, right, is if firms are earning the same average returns, they've got the same riskiness. You might worry, well, there's some mismatching about risk exposures along the size and value dimensions. We can repeat this exercise within these buckets, okay, matching on size and book-to-market characteristics, and we get basically the same results. No statistically significant difference between early and late announcers. So it's not a traditional risk story driving this. So now let's look at our risk exposures and announcement timings. Okay? In our model, right, what drove exposure to the early versus late factor was when you announced. Okay? So if the Fama-French factors are partially exposing us to this, we should expect to see movement and exposure to the Fama-French factors being driven by when you announce. Right? So this is our first prediction, right? SMB and HML exposure should vary not just with your book-to-market and size characteristics, but when you announce. So the idea here is that since big firms announce before small firms, if a small firm announces early, like when big firms announce, it should have an SMB exposure like big firms, right? It should behave like a big firm, right? Similarly, a big stock that announces late, right? It should have an SMB exposure like a small firm, right? It should behave like a small firm. Okay, so this gives us our first hypothesis, right? SMB betas should increase across months within a quarter. Okay, so month 1 announcers should have lower SMB betas than month 3 announcers. We have similar predictions for HML, right? Because value stocks announce on average before growth stocks. So a growth stock that announces early should have an HML exposure like a value stock. And similarly, a value stock that announces late should have an HML exposure like a growth stock. Okay, so our second prediction is HML betas should decrease across months of the quarter. So our month 1 announcers should have higher HML betas than our month 3 announcers. Okay. So let's look at this and see what we find. We did it 2 different ways. One, we just looked at when a firm announced, calculated its beta over the period of 60 months, okay, and took averages across all firms that announced in a quarter. Got very similar results to our preferred methodology of basically performing a triple sort. So we do the standard sort on size and book to market to form the 25 Fama-French portfolios. And then each of those 25 portfolios we sort into 3 different portfolios, okay, based on you're an early, middle, or late announcer, right? Announce in month 1, month 2, or month 3. And because firms have different announcement patterns each quarter, right, we do this separately for each quarter, right? Because sometimes a firm will be a month 1 announcer in quarter 1 and a month 2 announcer in quarter 2. Okay, so to take into account that, right, this is sort of really a quarterly phenomenon. Okay, and then with these triple sorted portfolios, we're able to calculate a portfolio beta, and then we can perform statistical tests on the long-short portfolio of the month 3 versus month 1 announcer to test our hypotheses. So let's look at our results. Okay, so here's our results for SMB betas in quarter 1. So on the vertical axis, we've got all of 25 of the Fama-French portfolios, and then moving across, we've got our month 1 announcers of the triple sort, our month 2 announcers, and our month 3 announcers. So remember, our prediction here is when you announce later, you should act more like a small firm, so your SMB beta should go up. So I've color-coded things to make it a little easier to see because there's a lot of numbers. So light gray means we're getting the pattern predicted. Okay? Dark gray means it's significant at the 10% level. Bold means it's significant at the 5% level. And red means it's significant at the 1% level. Okay, so we're seeing the vast majority of firms are not only have our pattern, right, but they're also highly statistically significant. Okay, and when we look at this across all 4 quarters, okay, almost every combination matches this. And the ones that don't really match it usually only go opposite direction very small. So we get almost everyone is our pattern and statistically significant. Okay? Moreover, beyond statistical significance, the economic magnitude here is large. Okay? Changing your announcement pattern, okay, moves you between 1 and 2 quintiles. Okay? So if you're a very big firm and you announce late, right, this is like moving you to the next quintile smaller, between 1 and 2 quintiles smaller. If you're a very small firm and you announce early, right, this is like moving you between 1 and 2 quintiles larger. Okay? So big economic effects. Finally, let's look at our HML exposures. Okay, so remember our pattern here was the opposite, same color coding. Okay, and we see, again, the vast majority follow our pattern predicted and very statistically significant. Not quite as strong as the SMB results, but we also didn't see quite as strong of a pattern in the differential earnings timing along the HML dimension. Okay? So what we've shown here, right, again, similar economic magnitudes, right? Changing when you announce from an early announcer to a late announcer, again, moves you between 1 and 2 quintiles along the value dimension. Right? So we've shown, right, different exposure, different announcement timing gives you different exposures. Right? So let's kind of pull this all together and see what we've got. Okay, so what we modeled is how lumpy information release, which is very different than our kind of continuous, sort of uniform information release, gives us a very interesting factor structure in returns. Okay? This happens even among equally risky firms. Right? We're not arguing these firms have to be equal risk. We're just showing, right, even when they are equal risk, you can get this interesting factor structure. All right? We go and look at the data, and we find strong support for this, right, mechanism. Right? Our Fama-French model, right, most of its improvement is happening in the early periods of the quarter, right, when most earnings announcements are happening, right, up or around 80% of the improvement happens in the first months of the quarters. Right? We see consistent differences in when firms sorted on the Fama-French characteristics announce, right? Big firms announce before small firms, and value firms announce before growth firms, all right? We find evidence that early and late announcing firms have the same risk. We also find evidence that the market premium is concentrated in early months of the quarter, right? And the factor premiums are concentrated when the long end of the portfolio tends to announce, okay? And kind of what does this mean, bigger picture, okay? So bigger picture means we have to consider the information structure and risk jointly in determining our factor structure, okay? So when we typically think about investing in, say, a small stock portfolio or a value portfolio, we tend to think, we're exposing ourselves to some different type of risk. And maybe we are, but what we have to also think about is maybe we're not really exposing ourselves to some different sorts of risk, right? We're just mismeasuring the risk, right? We're miscapturing the market beta, right, because of the interesting covariance structure that comes out, and we're going to a lot of effort to expose ourselves to risks that maybe really aren't there, and right, we're just ultimately exposing ourselves to market risk. We're not arguing that all of the Fama-French exposures are driven by this effect. We're just showing, look, a large portion of it seems to be driven by this. Right? There's been a lot of work in the academic literature to explain where these factors come from. Right? They've been used just empirically because they've worked. There's a lot of stories out there trying to explain them. So any future story, right, has to really match these seasonalities. Right? We're showing there's really strong seasonalities in these factors. We're showing there's really strong seasonalities of when the model improves and when it doesn't over the CAPM. So any story we've got, if you don't like this one, right, you've got to at least explain these new interesting facts in the data. Okay? And finally, we show a way that we can connect characteristics to covariances, right? This has kind of been the thorn in, right, traditional asset pricing side, right? We've got characteristics, we've got covariances, right? You use characteristic corrections, you use covariance corrections, they give similar results, right? They kind of move together, we really don't understand why, right? Sometimes you think of them as proxy. So our model gives a way you can generate covariances from characteristics, right? If you just happen to have a characteristic correlated with when firms announce information, right, which we have here, right, size and book-to-market ratios are correlated with when firms release information into the market, okay, and just having information release correlated with some characteristic, okay, this information release can then generate an interesting covariance structure in the economy. So we are left with a way we can connect these two seemingly disparate results that have been sort of connected empirically, but not really deeply understood theoretically why they fit together. All right. So that's all I have. Thank you very much for your time.